Mr. Agent guy. So,
Yeah.
okay. But I can, if you would like, if that is a problem, Tim, I can put this on an unlisted YouTube channel.
No,
So it's up
I'm
to
just
you.
kidding.
Okay, just oh,
Nobody,
you mean your agent, like your talent agent?
exactly. Like nobody paying me for
I
this. So
that vision of loveliness that we
that's right.
have,
That's
right?
right.
So I see, I gotcha. Excellent. So, okay, so my name is Kim Sherman Labram. I am with the Small Business Development Center. I am the training coordinator, meaning that if there's training that comes out of the Small Business Development Center at Boise State, I've had a hand in setting it up. Our SBDC is a service that exists to help entrepreneurs, and we do that through a core set of services. One of those is confidential, free, one-on-one mentoring consulting, which you are all small business owners, and if you're not taking advantage of our services, you certainly should. It's the best deal in town. We've got a really great staff, and
you tell her you were done. No, one fetch and you're done.
No, I'm going to mute Heather.
No, I mean, did she tell you she was done?
Okay. There we go. Anyway, but we have the free consulting and consultations, and so I want you to take advantage of that. We also do training, and the training is either done in-house by our staff, or if we don't have a content subject matter expert, then we reach out to the community. And Tim was kind enough to actually reach out to me, and I was like, oh, we have questions about taxes and stuff all the time. Obviously, that is a really big deal when you have a small business. So we have people in the community come and teach classes, and we're very lucky to have him teach this class for us. And then finally, for those of you who are potentially working from home, well, I guess we're all kind of working from home right now, but eventually maybe you'll want to not work from home and get out of that back bedroom. We actually have 2 accelerator spaces. One of them is in downtown Boise, kind of by the Flying M, and the other one is in Nampa, right behind the Idaho Center. Both of them, I believe, have space. The one in Boise is strictly office space, and the one in Nampa is a combination of office space and light industrial space. So depending on your needs, if that is something that you're looking for, please by all means let me know, and I will send you the information. And with that, I'm going to stop talking and let our brilliant and wonderful Tim, whose agent has allowed him to be recorded, to start talking about the exciting world of taxes for small businesses.
Oh, thank you for that introduction. Brilliant.
You're gonna have to live up to that now.
I know. I was thinking, could you send that to my wife? That was like amazing.
So, I'll do my best.
Thanks. I'm just excited to be with all of you today, and it's amazing how much has changed since the last video that we did, Kim.
It's so weird.
I feel like I have whiplash from how quickly things change within the last few months. And my hat's off to all of you for having a small business and for looking to start a small business in this environment. This environment is definitely unique for small businesses, and navigating it is incredibly important and vital to your success if you've already started a small business, or for your success if you're looking to start a small business. This is my full-time job as I'm in my accounting firm. My family and I had a great idea. We started another small business on the side, a greenhouse business. That sounded like a great plan back in October when we started doing it. And come February, I was not sleeping really well. It was nothing related to taxes. I wasn't sure we were going to be able to open our greenhouse business, and we had committed a bunch of money. And so as a small business, I own 2 small businesses. So I guess I'm just trying to say, I feel your worries, your concerns, and yeah, it's fun. It's fun and stressful all in the same time. So occasionally you might see me drink from my beverage of choice. I am trying to get a sponsorship from Diet Mountain Dew. So I told my wife, it wasn't until just recently that I realized Mountain Dew was made by PepsiCo. I just thought it used to be a gift from God, comes straight from the heavens. But I guess it's actually made by Pepsi. So if you know anybody, let them know I'm sponsoring. I'm willing to sponsor them. So this entity selection, when starting out a small business, this is kind of small business 101. This is where we start, and it's one of the most important decisions you can make out of the gate, and probably the one that most small business owners are least qualified to make. in terms of what do we want to start a business as in terms of an entity. So I thought that's a great, because this is a question I get from all my clients. A lot of times as a CPA, I see it on the back end. I have somebody come in and say, hey, we started a business and this is what we did. And then it's like, okay, we're kind of stuck with decisions you made, and we either have to change, if it's better for you, we can have to change, or we have to go through the process of changing. And that can be laborious and expensive on the back end versus spending a little bit of time up front to make the correct decision. So I'm part owner for Zwygart John Associates. We're out here in Nampa. I'm the partner over the tax group. We do have an audit group. 10 employees. We're over here by Costco area. It's kind of fun to be amongst all the people. I got received a bachelor's degree in accounting from Brigham Young University. Got my master's degree in Boise State. I've lived in Idaho most of my life. Born and raised here in Nampa. So been doing tax ever since I got out of school. It's been a great experience. That's one thing I love about tax is it's always changing. I never get bored because they keep changing the rules on us. Sometimes the last second, and it makes it very interesting for a career. And I also have really enjoyed tax because of the variety of small businesses that I get to work with. It's never a boring day, from truck drivers to what do I do? To dentists and doctors to manufacturers. It's just really exciting to be part of everyone's small business and have an input in kind of how they're doing stuff. So to understand kind of the differences between entity classifications, it's important to understand that there's different types of taxes. And this can get a little confusing. And this is something that I have a brother who owns his own dental practice in Colorado. And this is something that after years of working with him, I don't think he still understands the differences in the types of taxes. He just gets confused. So don't be afraid if you don't understand. And because of the subject matter, I'm going to keep it at a high level, and we're going to move maybe a little quick. And so if you have questions, don't ask them because I'm just kidding. You can ask your questions, but there's probably going to be more questions than we have time for. So if you want to shoot me an email after the fact or give me a call, I'm more than happy to kind of help you through some of those questions. So some of the real generic, and this isn't even all of them, but the big ones we can talk about: income tax. Everyone's really familiar with income tax. We have to talk about the capital gains tax, payroll taxes, and self-employment taxes. And so these are the four big taxes that we're going to talk about today in regards to entity classification, and kind of how those interact and interplay with your decision on what type of an entity you would like your business to be. The first and the simplest form that you can choose is just to be a sole proprietor. And this is really, it's so easy because there's nothing you need to do. You just go out and start a business. You don't have to file anything with the state of Idaho. You don't have to do anything unique. You don't have to go get an EIN. You can use your social security number. And so you can just go out and start a business. The individual really is the business. The IRS ties your social security number to your business if you don't go out and get an EIN. But even if with the EIN, you're tied, the individual and the business are tied together. You don't have to file a separate tax return as a sole proprietor. There's a separate schedule that you just attach to your Form 1040. It's called a Schedule C. If you're the only employee, if you're the only person working in your sole proprietor, then you don't have to do payroll. So it's really easy, really simple to operate, start, and maintain a sole proprietor. All profits from a sole proprietor are subject to both income tax and self-employment tax. One of the other issues that we have with sole proprietors, and I have to give a caveat to this, as brilliant and amazing as I am not an attorney, and I cannot give legal advice. And so when it comes to the legal ramifications, I'm going to speak at a high level from what I know, but you really need to get help from an attorney on some of the legal issues. From my understanding of a sole proprietor, they have unlimited liability, which means it's, as a business owner, if you get sued for whatever reason, that person can come after not only the business assets, but after your personal assets as well, your personal home, car, etc. And so that's one of the big reasons why I usually have my clients never be a sole proprietor. And again, I work in conjunction with other attorneys to help them get set up so that there's not this unlimited liability. Now we'll talk about this coming up, but there's a way that you can be, from a tax perspective, be treated like a sole proprietor, but from a legal perspective, get some protection. And we'll talk about that in a little bit. This is something I added new from the last presentation. These are some real generic examples of the tax ramifications of the different entity selections. So as a sole proprietor, if we have a great year, we make $100,000 profits, we've got all this revenue, we apply all of our expenses, pay all our expenses. At the end of the year, we show $100,000 profit. Then that $100,000 again is subject to both the income tax and the self-employment tax. And this is where a lot of my small business owners get really surprised, because either they started out brand new, don't have experience with this, or they've been in business for several years, but they've never really made money. And then they finally have the first year where they're really successful. And then we prepare the tax return. And as you can see, the income tax isn't too bad. This is assuming a standard deduction and married filing joint. So the income tax is only $6,200, but then they get that $14,000 additional self-employment tax. And that's where people get really surprised and caught off guard, because they weren't prepared for the additional taxes. So a total tax is well over $20,000. And this gets really awkward for me when I have these conversations, because I tell them the other $20,000 and usually my client tells me, well, I don't have any money. Yeah. So that's when we hire the people for the tax resolution services. So, well, we can help you there. So I wanted to touch base because a lot of people have heard of corporations. From a tax verbiage, we call a traditional corporation, we call a C corporation, and you'll understand why, because we have S corporations. But a traditional corporation we call just a C corporation. It's got separate legal entity. It's its own legal entity. A corporation is so that has the benefit of the liability protection, because if someone's going to sue the corporation, they're suing that entity instead of the shareholders. And if we do everything, and again, I'm not an attorney, but if we do everything that the attorneys tell us, we get this protection as owners. They call it the corporate veil, where they can't go through and beyond the corporation to the shareholders, if we follow the ramifications of keeping stuff separate. That's my assumption is what most attorneys will tell you, is that you have to have a separate bank account. You can't commingle business and personal. And if you do everything by the book, then you'll have that liability protection. Corporations have been around for hundreds of years. We have a lot of case law in how those are to be treated. The downside of a corporation, of a traditional corporation, is double taxation. So all the profits from the corporation are taxed at the corporate level. The only way that an owner can get money out of a corporation is through one of two ways, either through a wage, through a payroll, or through a dividend. And dividends are unique animals in that they're not an expense to the corporation, but they get taxed at the individual shareholder level. So if we look at our example here, if our corporation has a $100,000 profit, that $100,000 of profit is subject to a 21% flat tax. And so the corporation will pay a $21,000 federal tax bill. Out of that remaining 79-ish thousand of cash, the 100,000 less the 21,000 we paid in taxes, that's available for a dividend. So if we put that all out of the dividend, then that would go to the individual shareholders, and it may be subject to long-term capital gains tax. And I say maybe because that depends upon each individual shareholder's individual tax situation. So capital gains can be taxed at 0% up to 20% based upon where you fall in the big scheme of things. And so corporations, again, I don't know if I've ever recommended for a client to go to a corporation. You might be asking, why would you want to be a corporation? Those are, if you're a huge corporation, you have to be a corporation to be traded publicly, like on a stock exchange. And so that's one of the reasons you have corporations. They have modified some of those rules because there are publicly traded partnerships. Those are really popular for real estate and for oil and gas purposes. But for small businesses, I honestly, like I said, I don't know if I've ever recommended a corporation. I know I've seen them. What I see a lot of is corporations were popular back in the 70s and 80s for farming purposes. And so I still see some farms that have come through as corporations. And the reason for that is because corporations can get pretty aggressive in what they can deduct. And so you get these family farms that would set up a corporation, and they would throw their house in the corporation, and then they would deduct all costs associated with the house. And since all the family were employees, they would deduct everything associated with supporting that family, food, and on. The downside to that was, which people didn't figure out until later, was that you don't want appreciating assets in a corporation, because so you put the family farm in the corporation, but back in the 70s, that farmland was only worth a couple $100,000. You're in Canyon County or Annie County today, and you're selling that same, you're going to sell the family farm now for development, and that farm's worth $3 or $4 million. Again, the only way to get the money out of the corporation is through dividends, and so that $3 or $4 million gain would be taxed at the corporate level, then taxed again at the individual level. So that's always another fun conversation to have with clients. Another example, another entity selection you can choose, and these are gaining a lot of popularity, is the limited liability corporation, the LLC. LLCs are relatively new and they're really unique. So that's one of the positives is they're really flexible. You can set up, and then this is where I was talking about as a sole proprietor. So because if you're a sole proprietor and you want the liability protection, well, then you can set up a limited liability corporation. When you go and you fill out as an LLC and you say there's only one owner, then the IRS looks at that and we call that a single member LLC, a single member limited liability corporation. And from the IRS's perspective, they say, well, you really, a partnership with or business with one owner, it's really nothing. And so we call it a disregarded entity from a tax perspective. And so they let you, from tax-wise, report it on your Schedule C as if you were a sole proprietor, but then you get the liability protection as if you were a separate legal entity. So from a tax perspective, you can choose the one of three ways to how you want your LLC to be taxed. You can set up as a single member LLC if you got the one owner, or you can choose to be taxed as a partnership or a corporation. And so right out of the gate, you have that flexibility to choose. And again, based upon a conversation you just had, why would you want to be taxed as a corporation? Well, I'll tell you in a little bit. So I'm going to keep you anticipated the EIDL level high. Depending upon how you choose which entity structure you're going to be treated as, determines how you're going to be taxed. You could be taxed and maybe all subject to self-employment tax if you're treated as a partnership or as a single member LLC, or it could be subject to that flat tax of 21% if you choose to be a corporation. Now, these are relatively newer entities. I think LLCs started coming on being popular back in the 70s and 80s. And so we've only got 40 years of case law. And so a lot of this stuff is still just kind of beginning to work through the courts as people test the limits of the LLC. And so that's one thing to be considered. You know, if you do an LLC, we have to be careful not be super aggressive, or else it will gain IRS scrutiny. Partnerships, another one that's been around for a long time. The reason why partnerships are so popular is that they're very flexible in how you can treat and handle stuff. They are considered what we call a flow-through entity, meaning that we file a separate business tax return, but the business itself does not pay tax. The tax return just reports all the profits, the revenues, expenses, and then shows the allocation between the various partners. And then we issue a K-1 from the partnership to each individual partner. And then they use that K-1 to report their share of the profits or losses on their personal tax return. So that's nice in that there's no double taxation. There's only the one level of taxation. Although it does have to, a partnership has to file its own tax return just to report that information for the partners. Now, a partner can effectively get paid. They can't, so partners aren't supposed to receive a W-2 wage in most situations. There's an exception for all things, but so we can set up a guaranteed payment. So if you have multiple partners in this partnership, but there's one that's really doing all the work, we can give them what we call a guaranteed payment, which is effectively a salary for their efforts for what they're doing. And that's kind of separate from their ownership interest. That guaranteed payment is subject to self-employment tax on the individual partner's tax return. And depending upon what type of partner you are, your profits, if there are profits, can be also subject to self-employment tax. And by what I mean, what type of partners is you have, some people will call it silent partner. They're better from a tax perspective. It's going to be passive versus non-passive. A passive, and there's strict rules to determine whether you're passive or non-passive. If you're involved in the business at all, then you're going to be deemed non-passive, and your income will be subject, your profits, your share of the profits will be subject to self-employment tax. If you can meet the rules to be a passive partner, a limited partner, then your profits will not be subject to self-employment tax. And so that's always a lot of discussion about that in terms of with my clients, and if we have multiple partners, helping them determine which partners are passive and non-passive. And that's done at the individual partnership level. So a lot of reasons I'm having those conversations with my clients is because my partnerships are family. And so we're trying to figure out how to best work the family dynamics. I always tell people that I feel like I would have been better served as an accountant if I'd have gotten a degree in psychology with a minor in accounting, because a lot of what I deal with is counseling families and individuals and through some of their more personal stuff. In fact, I tell clients I've got a psychology rate, which is twice the rate as my accounting rate. And I put them on different hats as we go through. The S Corporation. This is one that I'm fairly fond of. Allows us to have the benefits of a corporation without the double taxation. And it also allows us to control how much of the profits are subject to that self-employment tax. Because S corporations are such a good deal, there are a lot of strict requirements on how they're set up. We're limited into only having one class of share. And so you got to be really careful that you're not doing stuff if you have multiple shareholders. You're not doing stuff that makes it look like there's two different types of shares, and that all shareholders have to be treated equally, or it can violate the S election. We can lose that S election and not be an S corporation anymore. It's a flow-through entity, so the S corporation itself doesn't pay any tax. It does the same thing where it prepares its own tax return to report the revenue, all the expenses, and then each individual shareholder gets a K-1 to report on their personal tax return. If you own more than 2% of the S corporation, then you're required to pay yourself reasonable compensation. And this is where the fun begins, because we have to, there's not a bright line test for what's reasonable compensation. It's a facts and circumstances type of a test. And so we can determine how much to pay each of the greater than 2% shareholders. So this is the game that we play. I don't like to use the word game. This is the tax strategy that we use to help clients save in taxes. And this is strictly a play to save on self-employment tax. It will have no impact, virtually no impact upon the income tax between like a partnership or an LLC and an S corporation. The income tax ramifications can be relatively similar. This is strictly a strategy we use to save on self-employment tax. And I'll show you an example here of how that works. So if you remember our example of the sole proprietor, and even the example of a partnership, an LLC would be the same. So if you're subject to that self-employment tax, that $100,000 is going to flow through your personal tax return in some way or form and be subject to both income tax and self-employment tax. So what we do with the S corporation is we have that $100,000 profit, but we have to pay the shareholder a wage. So let's say it's just one shareholder. And so we pay that shareholder a $50,000 salary. And we run it through the payroll system. We pay payroll taxes on that. And at the end of the day, after we paid that salary, so that $50,000 salary is an expense to the business, but it's income to the shareholder. So it'll be picked up as a W-2 wage. So you can see it from an income tax perspective. We have a $45,000 profit because we have that $100,000 less, that $50,000 salary less the payroll taxes. So that $45,000 profit is going to flow through on a K-1 to the individual shareholders' tax return. So that's going to flow through as subject to income tax. But then we have this W-2 with $50,000 of wages, which is going to be subject to income tax. And so you can see we effectively have $100,000 that's going to be subject to the income tax. But what we just did is any of the profits, that $45,000 that flow through on the K-1 are not subject to self-employment tax. And so what we effectively did is you see my example here, the income tax is a little less than $7,000. but we cut the payroll tax by over $6,000, if you remember the example of the sole proprietor, because we were able to protect that $45,000 for being subject to the 15.3% self-employment tax. And so this allows us the flexibility to determine how much we want to subject that self-employment tax. And comparing the simple examples that I provided, we save over $6,000 in self-employment tax by virtue of executing this strategy. The caveat to this tax strategy is, there's rules. So if you can see what happens here, all the profits from an S corporation that flow through on a K1 are not subject to self-employment tax. And so a lot of my clients are like, well, we need to get super aggressive and pay myself as little as possible. How about we pay myself zero? And we can just, all that $100,000 comes through and not subject to self-employment tax. And that's the guaranteed way of getting an audit. And so, I'm happy to do that because that helps those of us that do tax resolution generate more fees. If, audits are good for me. But if every court case that I have seen and read where the IRS is challenging reasonable compensation of a greater than 2% shareholder in an S corporation has always been they've usually paid themselves zero. And for some reason, it's always accountants. Guys who know better, they use their own firm as an S corporation, and then they don't pay themselves a wage, and they just try and I shake my head. I'm like, yeah, come on, you know better than that. But so that's the reason I like the S corporation. So you have to pay yourself reasonable compensation, and this works really well when we have a pretty consistent cadence that we know that we're going to be relatively profitable year after year. If it's going to be kind of up or down, if you got losses 1 year and we still have to pay ourselves reasonable compensation, then that can get kind of iffy on the benefits. So the other point I wanted to make on this is because we get super aggressive. We do a low salary. Let's say it's okay with the IRS, but it's really low. The other caveat to this is people then kind of get surprised. I've heard from other CPAs who've retired or gotten towards the end of careers where they've been doing the strategy for 30, 40 years with some of their clients, and then their clients go to retire and they go to collect Social Security, and Social Security is really low because they were only paying themselves a really low wage and that's what the IRS or the Social Security Administration uses for calculating the Social Security. So if we're going to exercise this tax strategy, and I'm always trying to tell my clients that we've got to really offset those taxes that you're saving by playing this game really need to be put into some type of a deferred retirement account, IRA, or and we have lots of choices with retirement accounts to help that, because you are reducing how much your Social Security will be in the future. And so that's the big caveat to that. So now you're all experts. And there's been no questions, and I'm out. All right, so I'm anticipating that there's going to be some questions. I went through that relatively quickly and at a high level. And like I said, I'm sure there's going to be some confusion. I'm more than happy to answer any questions.
So most of you are unmuted except for Heather. So just go ahead and jump out and just ask your questions. Put him on the spot, test his knowledge, see if that BYU, BSU education is paying off.
I have a question.
Sure.
So Tim, if you have a partnership, how is your business affected when you do separate doing business as names? So you have a couple of different things. You're registered as a partnership, but you have a couple of different things going on, and you're registered as doing business as. Is that just like a nothing, or?
So are you saying that like you've got a partnership and you've got multiple partners, but you've got multiple businesses that are basically DBAs that are flowing up into the partnership?
Yes, let's put it that way.
Yeah, I mean, in a lot of ways, that's kind of similar to very similar to what I'll call like a consolidated return. So everything is going to flow up into that partnership. And so we would just have separate books for each of the DBAs and then just consolidate them up into one set of books for filing a tax return. So a partnership may not be the best. And so I get clients that are trying to be really creative in how they do stuff and then trying to save money at the same time. So they don't want to set up multiple entities because it does cost money to set up an entity. So they want to use one partnership to participate in all the different business ventures. And it may be better to separate some of those. You know, for example, like if I have a partnership for doing my stuff, but then I want to do another business with another person. And instead of, you know, we'll just go all DBA and we'll split it 50-50. Well, that gets a little kind of messy and hairy in terms of tracking it and stuff. And so I don't know if that answers your question.
Yeah, it certainly, it helps. Yes, thanks.
And if you want to call me with more details, we can talk about that later, just so I can get a better understanding.
Okay, I have a question for the LLC because that's registered in for our fencing company. I just feel like there's a lot of taxes there and I felt overwhelmed. Can you kind of go over some of those taxes? Because we have, my son is going to hire a helper for him to help do fences. And so we'll have to pay the helper, and I just feel kind of overwhelmed by all of that.
I don't blame you. It is overwhelming to initially get all that stuff set up, and I totally understand that. And especially when you start having payroll. Payroll is one of those things that's really easy to maintain. It's can be a little complicated to get off the ground. So from an LLC perspective, you have the taxes associated with the LLC, which again, an LLC, depending upon how you're structured, if you've got multiple members in the LLC, will be taxed like a partnership, which means the LLC itself doesn't pay income tax. But if the LLC has employees, then it will have to remit payroll tax for any of its employees. The way that you do payroll is you have to go to once you have your LLC set up and have an EIN, you need to go to the Idaho Business Registration site and request from them. It's a multiple page application because they're trying to see what types of taxes they need to collect from you.
Okay.
And so, but once you get through the whole application process, they should say, okay, well, you need an Idaho withholding number to withhold Idaho income tax from employees. You need an Idaho state unemployment insurance numbers to do the SUDA and the SUI. And then you're probably going to need a workers' compensation policy. So to get workers' compensation. If you have a choice on the workers' compensation, you can go to a local insurance, Allstate or Farmers or State Farm, and they can write a policy. Or you can go to the state insurance fund, and the state has an insurance arm that can do the workers' compensation.
Okay.
And based upon that application process, and once they'll mail you all those numbers, and then they'll also explain to you the frequency and the cadence of when you have to file. They'll tell you that initially, usually on a brand new entity, they make you file this Idaho withholding forms on a monthly basis, the state unemployment on a quarterly basis, and the workers' comp, I don't even know. All over.
Okay, because it's just a lot of taxes and different things that kind of overwhelming me.
It is. I've had prospective clients come to my office to meet with me, and after we get done talking, you felt like I probably kicked their dog or something, and they walk out with their heads down, and I never hear back from them. So.
Yeah.
But that's why hiring a good bookkeeper or an accountant is vital. I know most small businesses are trying to save money up front, but while you save a lot of pain and hassle if you go visit with an expert, with an attorney and an accountant or a bookkeeper right out of the gate before you get going, that saves a lot of pain and anguish down the road, especially when dealing with payroll taxes. And is it Jeannie?
Carolyn.
Oh, Jeannie's our bookkeeper too.
Right.
So
I was referring to Jeannie, the bookkeeper, because I'm sure you do a lot of payroll.
Oh.
And so it's my experience has been that payroll is one area that is relatively easy, but I'm always nervous for my clients because it's once you make a mistake on payroll, the ramifications add up really fast and they're really painful. Income tax problems, I don't even bat an eye. It's like, yeah, we can work with the IRS, Idaho on that. That's not a big deal. But when it comes to payroll, they don't mess around.
They don't. They do
And
not.
so,
And just to piggyback on what Tim was saying is, you know, I often tell my clients, you know, you can either pay up front or you can pay at the back end, but you're going to pay. And so if you pay up front to have somebody do it right, then you don't have to pay for a mistake on the back end. That's usually far more costly than the initial, if you'd paid for it up front. So, you know, anyway, that's my little bit of knowledge on that. So.
that is correct.
You're
Can I
get
have
to
a
pay.
question?
Hi, Heather. Heather,
Okay.
tell us what you do.
I am a speech language pathologist. I've been in the Valley for 18 years. I started a private practice in the fall, and
Just in time for COVID.
Yeah, just in time for
Congratulations.
and to top it all off, I'm an upper airway specialist. So I see a lot of patients with breathing problems, cough problems, and I'm thinking I might be seeing a lot of post-COVID patients. So. My question is this: I have been, I'm an LLC. I have been doing things on my own, but as I'm getting bigger, I need to seek billing services, but I won't have these folks on payroll. I'd like to enter into an independent contractor agreement with these folks, but I'm wondering at the end of the year, what do I need to provide them in the way of what I've paid them?
Sure, that's a great question. And so when you start dealing with contractors, at the end of the year, in January, you need to issue what we call a Form 1099. And that's actually just changing. They introduced a new form that is effective for this upcoming year, because we used to file everything on a 1099 MISC miscellaneous, MISC, but now we have a new form specifically for these types of contracts where it's 1099 non-employee compensation, NEC, I think it's the abbreviation, non-employee compensation. So the important thing about a 1099, and you start dealing with contractors, is you need to request from them a form W-9. You need to give them a W-9 that they give back to you, which gives you all the information you need to complete a 1099 at the end of the year. Speaking from experience, I absolutely, and Jeannie can back me on this, I hate trying to get that information in January. Oh, it's miserable. The best way to get that form is say, I will give you our first payment once we get that W-9 back.
Nice, good.
And so
Okay.
collect them through the year, please. Your bookkeeper, your accountant will be very grateful. You will be very grateful if you do it yourself come January.
Okay. Good advice. Thank you. Okay. Any other pitfalls or concerns that I need to worry about? Just having contractors, or is that the biggie, the 1099?
That's a big one. I mean, that is an area that's coming under IRS scrutiny and state tax and agent scrutiny. Is the difference between an employee versus a contractor. For billing services, I don't think you have to worry about that at all. What we see a lot of is, and I see some of my small clients, is they have effectively an employee, but they don't want to run payroll because payroll's complex. So they're like, I'll just 1099 you. That actually happened to my son. He worked for a farmer, and at the end of the year, he got a 1099. I'm like, wait a minute, this is not right. You're not a 1099 day laborer. You're an employee, and so that's one issue that's going under scrutiny by the taxing agencies. The one thing that I just saw some statistics earlier this week. If you're LLC, if you're a single member LLC or a Schedule C or sole proprietor, and your business is starting to be successful, the Schedule Cs that make over $100,000 of profit are the highest audit rates out of anything that the IRS looks at. Okay. And so if you're starting to, it's funny because you take that LLC, we make an S election, become an S corporation, and your audit rate goes from a 2% chance to like less than a 1% chance just by virtue of switching it to an S corporation. Nothing else changes. But because you're from the IRS's perspective, when you got sole proprietors, once you cross that $100,000 of profitability threshold, you're a big fish in the sole proprietor Schedule C arena. So they're going to really take a look at you. But by virtue of an S corporation, you get dropped into a bigger bucket of S corporations that are making billions of dollars. And so your $100,000 of profit all of a sudden doesn't look all that big of a deal. And so your audit risk falls substantially. And so something to consider.
Anyone else? More questions? Don't be afraid to ask. You could even chat them privately to Tim or myself if you're shy.
Kim, I'm just kind of noticing, I mean, do we have any gentlemen on this call, or is it just all?
Just you, sir.
Well, that
So-
explains everything. They all caught it the first time through. If there was a guy on here, we'd have to repeat it.
They were listening. So yeah, we had a couple of guys register, but they did not show up. So they'll get it on the record, and they don't get to ask their questions. So although Tim was kind enough to include his contact information right there, and the email that I sent out with the Zoom information had him copied on the email as well. So you should be able to get a hold of him. And if you lose all of that, then you can always email me, and I will put you in contact with him. So no other questions? Does this mean everybody wants their 15 minutes to go do something else?
Or, and Kim, if people want to ask questions outside of this, I'm also available if we want to talk about PPP, EIDL, Rebound.
Are you all up to speed on those as well?
I can't wait for them to go away.
Well, we've been doing a lot of webinars on those ourselves, and yeah, obviously we've been doing a lot about that. So it's the unemployment, the PPP, the rebound, the PUE or PUE, whatever. So yeah, it's been kind of crazy. So are any of you? You're all pretty new businesses. I'm guessing none of you kind of qualify for any of those, do you?
I did qualify for the PUA, but I just attended the webinar this morning, Kim, that you all did.
Great.
And there's some glitch, but they're dealing with 48,000.
I know. It's crazy. Josh said in one of those webinars, now Josh is our contact at Department of Labor, and he said that basically they called everybody who had retired back and said, you have to come back and work because of the sheer volume of unemployment things. Although from what they said on the webinar this morning was that things have slowed down enough, and if you haven't gotten your PUE or unemployment, it's because there is something that needs to be manually dealt with by a human. There's the automated system has hit that wall and said, I don't know what to do with this, so a human has to look at it. So but they are getting through them as they go along. So, and for those of you, I mean, Tim, why don't you talk a little bit? I'm sure you know more about these than I do. I know kind of the surface of them, and because I have a subject matter expert in our office who that's all she does is read up on this and do it. But the Rebound Grant, I don't know if some of our people on the call might actually qualify for it. Possibly. I know that they wouldn't for the PPP, they wouldn't for the EIDL. So the stuff from the CARES Act, but possibly from the state perspective?
Yeah, that's a great question. And to be honest with you, like I know some, but maybe probably enough to be dangerous, because what's been so fascinating is my tax season was going along just fantastic until COVID-19 hit. And even then it wasn't too bad until they released a couple $1 trillion. Mm-hmm. And then my tax season just went to heck because I had, and I feel, if you're working with CPAs or bookkeepers, I'd say please be patient, because I lost 6 weeks worth of work just answering questions for emails and phone calls. I mean, it was overwhelming. Mm-hmm. And so like, I find it like back to preparing tax returns and stuff, maybe have not been on top of some of the stuff. What was scary for me in terms of like some of this PPP stuff is just because we had the rules and I had a bunch of clients apply for it and then get the money, and then you start seeing the rules change after the fact, and you're like, oh, maybe we shouldn't have taken this, and then they change rules again. Okay, we're okay now. Mm-hmm. And
so Tim, the one thing that I can say about that we are recommending is they do not have to apply for forgiveness until is it June 30th or July 31st or somewhere later this summer?
Right.
And we're recommending that they wait until the deadline to do the application because the rules do continue to change. So that's what we have seen and said, you know, it's not benefiting you to apply now rather than in 2 months. So you might as well wait and let them hammer out the issues.
Right. No, exactly right. I am seeing movement with some of my clients on the EIDL. That was kind of initially a black hole. People applied and we heard nothing.
Yeah.
And then they started working through some of that. And I've actually had some clients actually get their loans.
Oh, great.
And so that's moving. The rebound, that's a great question. I know if you don't qualify for the PPP, then you can get the rebound loan or the grant. I have had some clients run into issues though because they started up a business in December timeframe, but it didn't really get operational for January.
Right.
And so there's kind of a gap, it seems like, for businesses that started in 2020.
So there is a gap, but there's still money in the fund. And so they're on round 3 of funding.
Right.
And I've heard whispers of potentially a round 4 if there's still money in the fund. So, you know, round 1 was, you know, people with employees from 1 to 19 and then 1 to 50, I believe. And now they're really looking at those sole proprietors with no employees, I believe. So they're trying to, you know, and we're able to communicate with the governor's office and the whatnot about this. And so I think it's changed. They're like, oh, this is a whole group of businesses that we didn't even think about. And so they're like, let's open the funding to them. They've been, you know, they hadn't been allowed to, and now they are. So it's worth going out and looking at the Idaho Rebound Grant. They just started the 3rd round of funding on Tuesday. And like I said, I heard whispers about a 4th round potentially coming before too long as well. So
Kim, I have a question about that. We learned this morning then that you can, because they both come from the federal government, you can be eligible for the PUA or the Rebound Grant, but not both.
Right.
I'm just wondering in terms of the determination, I would be probably in that 3rd way where I'm a single LLC, single owner LLC, no employees. But because my PUA was, I guess I'm monetarily eligible, but no payments have been made, I would need to withdraw that if I became eligible for the rebound.
Right.
In terms of how the distribution is determined, do you think it would be equitable? I know it says up to $10,000. I mean, I need PPE for my patients, and that stuff is not cheap. And then I applied for the PPE, masks, gowns, whatever it was.
The supplies.idaho.gov.
Yeah.
Good. Okay.
And so I'm in that pipeline, but I don't know which one would be more
would give you more money, and I don't know that off the top of my head either. I know that, and one thing Tim mentioned, so on PPP, the last I heard, and maybe this has changed, but if you got less than $10,000 on the PPP, then you can still apply for the rebound grant and get the difference between whatever you got for PPP to $10,000. That's okay. Now, granted, this morning was the first time I've sat in on the webinar in a while, so I could be wrong. What have you heard about that, Tim? Do you know?
I don't know. Honestly, I haven't spent a whole lot of time on the rebound stuff because most of my clients qualified for the PPP.
Okay, that's good. Heather, do me a favor, follow up, send me an email, and I will get you in contact with Ruth, our subject matter expert here. She was on the webinar this morning, I think.
Yes.
And so we'll just get you in contact with her, and she will be able to answer that for sure.
Okay, and Kim, do you have your email handy?
Sure, it is it's K Labrum, and that's KLAB as in boy, RUM as in man, at Boise State.edu.
Thank you so much.
You're welcome. And we'll get that clarified. And so for those of you who are like, we're like PPP and EIDL and this, does everybody know what those are? And are you like completely, okay, so the EIDL is the Economic Injury Disaster Loan. It comes through the SBA, and it is a loan up to, is it 10 million, Tim? Is that right? Somewhere in that area.
Yeah.
For businesses to apply for. I believe the repayment interest rate's like 3.75%. And it's the kind of thing that comes out, the federal government releases the funds, SBA oversees it. And so like when Hurricane Harvey came through, you know, businesses that were affected by that, COVID obviously. And so it is the one, as Tim mentioned, was kind of a black hole. Their system was so overwhelmed when it first hit that they just, there was no way for it to kind of take, kind of like our Department of Labor's unemployment insurance. They had no concept of the sheer mass of people that were going to apply. So the Economic Injury Disaster Loan requires that you have been in business, that you have employees, right, Tim? Am I right about that?
Well, the EIDL can be used to pay for payroll. It can be used to pay for inventory or other accounts payable type items, and other like rent and utilities and those things.
Right. Okay. And so, but usually it's focused on established businesses. So for those of you who are still very new, which most of you are, EIDL is not an issue, is not even a thing. So in the EIDL, there was the I believe it's called the EEDG, the Emergency Economic Disaster Grant. And so basically it was up to $10,000 advance on the EIDL. And the $10,000 amount was predicated on how many employees you had. So if you had one employee, you got $1,000, and that was a forgivable portion of the EIDL. So if you had 10 employees, you could have gotten the full $10,000, but most people have 1 or 2 employees. So, but it is kind of housed underneath that EIDL. Then we have the PPP, which is the Payroll Protection Program. And the Payroll Protection Program is meant to maintain your payroll for the 8 weeks during COVID. And so it is literally 2.5 times the average of your payroll from 2019. And again, so if you've just started, or, you know, although they did loosen up some stuff so that you could put in 2020 numbers, but if you don't have any employees, the PPP was kind of hard. So the PPP, I've got clients that have gotten up to, you know, $150,000 depending on the size of their payroll. If you spend 75% of it on maintaining your payroll and keeping your existing amount of employees on staff so that they're not drawing unemployment, and then the other 25% can be used on utilities, rent, those kinds of reoccurring payments that you might have gotten behind on, then the PPP is forgivable. That's the one that we were talking about, that the guidelines are still changing, and we're, you know, literally day to day sometimes. So the one where I said, wait until we get to the deadline to apply for forgiveness to make sure that we have the right things in line. So, and then finally, so EIDL and PPP are all part of the CARES Act, which came out of the federal assistance money. And so then, and technically the state money came from the CARES Act as well, but it's overseen by the state of Idaho. So the state of Idaho got a pot of money from the CARES Act as well, and they said, okay, go forth and do something with it. And Idaho was one of the few states that said, we're going to set up a grant for people who didn't qualify for EIDL, that didn't get a PPP, or they didn't get a full $10,000 on the PPP. And they said, okay, apply for the Rebound Grant. And so the Rebound Grant is upwards to $10,000, and you apply through the Idaho State Tax Commission, and you use your TAP, your taxpayer access point. It's access point, I believe. And you apply through that portal, and then the money all flows through the State Tax Commission. And that's kind of the overview, and you may have tapped the depth of my knowledge on all of those programs right there. So even though I've sat through a lot of these, and it's very slippery. Every time I think that I have a really good handle on it, I think they change the rules, or, you know, somebody comes up with a new, but what about me? And I'm like, oh, I don't know. And that's where I go to Ruth Schwartz, who is our subject matter expert on staff right now. We were so fortunate in that we hired her the week that the state shut down. So she wasn't able to really start working as a consultant like what I do. And so we put her to work reading the CARES Act. And that's all she's done for the past 8 weeks is read the CARES Act and do webinars about them. And so she does them. She brings in Department of Labor, anybody that she can get to kind of bolster and answer questions beyond what she's learned as well. So if you haven't experienced those webinars, Heather said that she did. If you haven't, please do. I'm recording this. I'm going to put it out on our YouTube channel. All of those things are out on our YouTube channel as well, so you can look at them. And we have a few more coming up, and you can find them on our website at idahosbdc.org. So there's a good little pitch for that, and it's really good information. It's about a half an hour of information like what Tim did, and then a half an hour for questions where you can just really drill down and ask what you need and get specific questions answered that maybe weren't addressed in the content of the webinar. Does that help you all at least know what it is? Like I said, you all are new enough that I anticipate that most of you don't qualify for EIDL or PPP, but you should definitely at the very least look at Rebound. It doesn't cost you anything but a little bit of your time to apply, and you might get it. You might not, but it'd be worth 15 to 30 minutes of my time if I could get $10,000.
Yeah.
Right?
Sounds good. Thank you.
That's good return on investment, I think. So, all right. Anything else?
Thanks for your time, guys. Appreciate it.
Yes. Thank you.
Very much.
Thank you all. And so,
Everyone.
cool. Look for an email from me with the recording of this a little bit later, maybe today or tomorrow, depending on how YouTube is treating me. It took me 2 days to upload the one last week, so I don't know. It's just been one of those days. So, but thank you so much for tuning in and all your questions.
Thank you. Thank you.
Yep. Thank you.
And Tim, thank you so much. I appreciate this.
You're very welcome.
Have a good one.
Thanks. Take care.
Bye.